As of 10:23 a.m. Eastern Time on November 5th, Opendoor Technologies, ticker OPEN, is trading at $7.10 per share. That's a pop of 2.60% on the day. And for many people looking at that, this feels like confirmation. This is the iBuyer, the tech-driven future of real estate, and it's been one of the most explosive stocks of the year, up over 300% from its lows. The immediate expectation is that this 710 price is a stepping stone, a pause on the way back to its former highs, a sign that the worst is over for the housing market. But the hard, immediate reality that this 2.6% move hides is one of the most profound disconnects I have ever seen in the public markets. That $710 price is not a reflection of a healthy, growing company. It is the epicenter of a massive, speculative war between a retail-driven narrative and a wall of institutional skepticism that believes this stock is worth, in many cases, less than $1. This is a story that has absolutely captivated the online investing community. For years, the expectation for Opendoor was simple and powerful. It was the Amazon of housing. The model was supposed to be a fundamental disruption. No more realtors, no staging, no agonizing months-long process. You go to the Opendoor website, type in your address, and get a fair cash offer in 24 hours. They buy your house, do some light work, and sell it. It's the kind of story that gets self-investing individuals, many using the Robinhood app or SoFi Invest, to dream of Tesla stock or Nvidia stock level returns. The belief was that technology, data, and algorithms could wring all the friction and inefficiency out of the single largest asset class on Earth. This was supposed to be the new way, and the stock's prior surge to well over $30 was the market's stamp of approval on that dream. But the reality has been a nightmare. The reality is that this is not a high-margin, capital-light tech company. It's not like Apple stock, which just sells phones and takes a 30% cut of services. Opendoor is a high-risk, capital-intensive, razor-thin margin house flipper that has to hold billions of dollars of inventory on its balance sheet. And that model, which looked brilliant when interest rates were zero and home prices only went up, completely and totally broke. When the Federal Reserve began its aggressive rate hiking cycle, mortgage rates exploded from 3% to over 7%, and the U.S. housing market entered what can only be described as a deep freeze. We are in a state of gridlock. Recent data shows that 2025 is on track to have the lowest number of home sales in decades. This is the operating environment for Opendoor. It's a company that survives on transactions, and transactions have evaporated. Let's look at the movement of this $710 stock, because it's a case study in market psychology. The 52-week range is from 51 cents to over $10.87. That rise from 51 cents to over $7 is not, I repeat, not based on improving fundamentals. In fact, the fundamentals are getting worse. The company is guiding for third-quarter revenue to fall by a staggering 38% year-over-year. They are also guiding for a return to a significant adjusted EBITDA loss after a brief, much-hyped moment of profitability. So if the business is shrinking and losing more, why is the stock up 300%? Because this stock has detached from its underlying business. It has become a pure speculative vehicle. It is no longer an investment. It is a leveraged bet on a single macroeconomic factor, the Federal Reserve. The entire bull case for this $710 price is that the Fed will cut interest rates, mortgage rates will fall, and the housing market will unfreeze, saving the company from its own balance sheet. This is where the real war begins. On one side, you have this retail-driven hope. The stock is a mainstay on Robinhood stock trading lists. On the other side, you have the professionals, the shorts. The short interest in Opendoor is colossal. Over 161 million shares are held short, which is a massive 22.7% of the entire float. These are traders often using platforms like interactive brokers, who are not betting against the housing market. They are betting against Opendoor's margins. They see a company that, even in a good quarter, was only scraping by on an 8% gross margin. They know that Zillow and Redfin, both huge, smart tech companies, quit the iBuying business entirely. Zillow's CEO famously said, "The unpredictability in forecasting home prices far exceeds what we anticipated." Zillow and Redfin ran away, but Opendoor is still in that burning building. The shorts are betting that those razor-thin margins can't survive this frozen market. And this brings us to the most fascinating disconnect of all: the analysts versus the stock price. This is the investment help you will not get from a meme. As of today, with the stock at $7.10, the consensus analyst rating is a sell or strong sell. The average price target from Wall Street analysts is just $1.87. Let me say that again. The stock is at $7.10, and the professionals who cover it for a living at places like Citigroup believe it's worth less than $2. There are price targets as low as 70 cents. This is an almost unprecedented gap. Wall Street is screaming this is wildly overvalued, while the market, fueled by speculation, is not only ignoring them, but actively fighting them. The 2.6% pop today is just another small battle in that massive war. So, what is the company's response to this? This is where the story gets even more interesting. The new CEO, Kaz Nejatian, understands this dynamic perfectly. He knows Wall Street hates the stock. He knows his fundamentals are weak. And he knows his only real support is coming from the retail investor, the person using the Fidelity mobile app or the SoFi trading platform. So what is he doing? He is leaning into the narrative. First, he's changing the story. He's now talking about AI transforming the company's pricing engine. He's talking about accepting cryptocurrency for home payments. These are narrative-driven headlines designed to capture the imagination of the online investing world. But his most brilliant move is happening tomorrow. Opendoor is holding its earnings call, but they're not calling it that. They're calling it a financial open house. And they are live streaming it directly on the Robinhood app. This is a masterful PR move. He is literally bypassing the Wall Street analysts with their $1 price targets and going straight to the shareholders who are holding the stock at $7. He is inviting the Robinhood users, the SoFi stocks holders, to ask him questions directly. This is a public relations pivot, an attempt to solidify his support with the only investor base that still believes in the $7.10 price. He is reinforcing the expectation, while the reality of his own earnings guidance, which projects a 38% revenue collapse, gets swept under the rug of this new, shareholder-friendly transparency. So, what is the future outlook? Where does it go from $7.10? It's one of the most binary stocks on the market. This is not a stock for Schwab Intelligent portfolios or a safe Fidelity IRAs. This isn't a set-it-and-forget-it holding like a basket of Fidelity mutual funds or Fidelity ETFs. This is a high-stakes gamble for an individual brokerage account. The bull case, the expectation, is that the Fed cuts rates. That's it. That's the entire case. If the Fed cuts, mortgage rates fall to 5%, the housing market unfreezes, and Opendoor survives. The 22% short interest gets squeezed, and the stock explodes, making the Robinhood Investments crowd look like geniuses. The bear case, the reality, backed by the fundamentals, is that this doesn't happen. The Fed stays high, the housing market stays frozen, and Opendoor's razor-thin 8% margins aren't enough to cover its operating costs and service its massive debt. The AI and crypto talk is revealed as a distraction. The financial open house on Robinhood is seen as a desperate PR stunt. The company is forced to raise cash, badly diluting shareholders at these prices, or worse, its inventory of homes becomes toxic and it collapses under its own balance sheet. In this reality, the analysts at Fidelity and other investing sites are proven right, and the stock's $1.87 price target starts to look optimistic. Opendoor's model relies on a liquid, stable, or rising housing market. The current market is none of those things. I want to know what you're seeing in